Welcome to the deep dive. We're here to help you cut through all that information noise
Yeah.
and really get to the core insights you actually need. Today, we are plunging into SoFi Technologies, ticker SOFI, looking specifically at their Q2 2025 earnings report.
Exactly. And we're using our unique five-part framework for this deep dive. It helps us blend the company's own data from the earnings release with, real-time market info. It gives you a much fuller picture, lets you see beyond just the basic headlines of the earnings.
Okay, let's get started then. Now for slide one, the at-a-glance scorecard. So the big headline here for Q2 2025, SoFi delivered what many are calling a resounding beat. They really outperformed expectations, and it looks like accelerated growth. Let's hit those main numbers. Revenue first. They reported GAAP net revenue of $854.9 million. That was way above the Wall Street consensus, which was around $804.2 million.
A pretty significant beat on the top line.
And then diluted EPS, earnings per share, they posted 0.08 cents.
Right.
And the consensus forecast was only 0 and 6.
Yeah.
So 0 to 2 cents higher there, too.
So a clear beat on both metrics. And, well, the market definitely noticed. SoFi shares, they jumped around 10% in pre-market trading right after the announcement on July 29th. That initial jump, it was clearly driven by optimism, but also, importantly, by the fact they raised their guidance.
The guidance update, too.
Yeah, because before this report, the general feeling among analysts was more cautious, kind of a hold, maybe some worries about valuation. But these results, especially how much they beat by and management sounding more confident about the full year, it really started shifting that sentiment more positively. It kind of forces a rethink.
Right. Those strong numbers make you reassess.
Yeah.
Okay, so beyond just beating the estimates, let's look at the year-over-year picture. How do they actually perform compared to last year? Total net revenue, we said $854.9 million this quarter. Compare that to Q2 2024, which was $598.6 million. That works out to 42.8% growth year over year. Pretty
solid top-line growth, absolutely.
But here's where it gets, well, kind of wild. The bottom line. Net income attributable to common stockholders. It went from just $7.9 million last year to $97.6 million this quarter. That's, let me check the math, 1,127.2% growth year over year.
Just incredible growth on the bottom line. Astronomical.
And that translates directly to the EPS, right?
Yeah.
Diluted EPS went from $0.01 last year to $0.08 this year.
Yeah.
That's 700% growth.
Exactly. And when you see that kind of divergence revenue up 43%, but net income up over 1,100%, something fundamental's happening.
Right. It's not just a one-off thing.
No, it points straight to powerful operating leverage. Basically, their revenue is growing much, much faster than their expenses are. If you look at the numbers, total net revenue increased by about $256 million year over year.
Okay.
But their non-interest expense, that only went up by about $161 million.
So a much smaller increase in cost compared to revenue.
Precisely. It means they've scaled past a lot of their fixed costs. They've hit a real profitability inflection point. More of each new revenue dollar is just falling straight to the bottom line now. Profits compound faster. And what makes this even more impressive, frankly, is that they achieved this huge profit jump even though their share count went up.
Oh, right. Dilution.
Yeah. The diluted weighted average common shares outstanding went from about 1.065 billion to 1.182 billion shares year over year.
So more shares out there.
Right. Normally, more shares makes it harder to grow EPS because you're dividing the profit among more slices. The fact that EPS still grew 700% despite that dilution, it just highlights how strong the underlying operational performance was. This wasn't, financial engineering like buybacks. It was pure business execution.
That's a really important distinction, and maybe we should quickly clarify for listeners the difference between basic and diluted EPS, just briefly.
Good idea. So basic EPS is pretty straightforward. It's just the net income available to common shareholders divided by the basic average number of shares out there, a simple snapshot. Diluted EPS, though, that's what analysts really focus on. It's more conservative, more comprehensive.
Okay.
It adjusts for anything that could dilute earnings in the future. Things like stock options, restricted stock units, RSUs, maybe convertible debt. If those convert to shares, the share count goes up. So diluted EPS gives you a kind of worst case view of earnings per share, which is why it's the standard for comparisons.
Got it. That helps clarify why that 700% growth despite dilution is so significant. Okay, moving to slide 2, the engine of profitability. Now we know the top numbers look good, operating leverage is kicking in. Let's dig into how SoFi is actually driving this profit. And that bank charter seems important here.
Hugely important. Let's start with net interest margin, or NEM. That's a core profitability metric for any bank, right? It's the
Yeah.
difference between interest earned on assets, like loans.
And the interest paid on liabilities, like deposits.
Exactly. SoFi's NIM in Q2 was 5.86%. That's actually a slight improvement from 5.83% a year ago.
Okay, stable to slightly up. Seems good.
It is good, but here's the really interesting part. They achieved that NIM stability even though the average yield they were earning on their assets actually went down a bit, from 9.53% to 8.97%.
Huh. So how did NIM stay stable if the yield they earned fell?
Ah, that's the key. Because their cost of funds dropped significantly, the average rate they paid on their interest-bearing liabilities, it fell from 4.24% down to 3.47%.
Okay, so they're paying much less for the money they use.
Precisely. And that is a direct result of them strategically using their national bank charter. They've been aggressively gathering low-cost consumer deposits. Their total deposits ballooned to $29.5 billion. And this deposit funding is way cheaper than other options like wholesale funding.
Wait.
So FICA actually estimates this advantage. Having the bank charter saves them about $551.9 million in interest expense annually compared to if they didn't have it. That's a massive, durable competitive advantage over fintechs that don't have a bank charter.
Wow, okay. So that charter isn't just regulatory paperwork, it's a core part of their profit engine. That makes a lot of sense.
Yeah.
Now, sticking with profitability, let's talk about GAAP versus non-GAAP numbers. We see both reported.
Yeah, you always need to look at both to get the full story. So GAAP net income is the official number according to standard accounting rules. We said that was $97.3 million for Q2. Then there's non-GAAP adjusted EBITDA. This takes the GAAP income and adds back certain items, typically things like interest expense on corporate debt, taxes, depreciation, amortization, and a big one for tech companies, share-based compensation.
Okay.
So Paddle-size adjusted EBITDA hit a record $249.1 million this quarter.
Quite a bit higher than the GAAP number.
It is, but what's really encouraging here, and points to what I'd call the high quality of SoFi's earnings, is how close their GAAP revenue is to their non-GAAP adjusted net revenue. GAAP total net revenue was $854.9 million. Adjusted net revenue was $858.2 million. The difference is tiny, just $3.3 million.
Okay, so the revenue number itself is pretty clean.
Very clean, not boosted by weird non-cash items. And while the adjusted EBITDA is higher, the main things they adjust out, like that share-based comp, are pretty standard for high-growth tech firms. There aren't big, unusual adjustments happening. That builds confidence that the reported profits are sustainable and coming from the core business. Transparency looks good.
That's great context. Good to know the revenue is clean and the adjustments are fairly standard. Okay. All right, let's push on to slide 3. The engine room business segment performance. This is where we look under the hood at SoFi's 3 main business parts. They seem to work together, but they have different roles, right?
Absolutely. They're designed to be synergistic. Let's start with lending. This is, their traditional strength.
Like the original SoFi business, kind of.
Exactly. Still the biggest contributor in absolute profit terms, it brought in $244.7 million in contribution profit this quarter. Revenue grew a strong 30% year over year to $443.5 million. And that was driven by record loan originations, $8.8 billion total. They saw huge demand across the board. Personal loans were up 66% YoY, student loans up 35%, and even home loans, which can be tougher, jumped 92%.
Huge numbers.
Yeah. The contribution margin there is still really high at 55%, even though it compressed just a tiny bit from 58% last year. Still very efficient.
Okay, so lending is the steady, profitable core. What about financial services? That seems to be where the excitement was this quarter.
Oh, absolutely. Financial services was the real growth catalyst, the primary driver of the upside surprise, frankly. Revenue there more than doubled up 106% year over year to $362.5 million.
Doubled. Okay.
And the profit growth was even more explosive. Contribution profits surged 241% year over year to $188.2 million. And look at the margin expansion from 31% last year up to 52% this year.
That's a massive jump in margin. What drove that?
Here's the really interesting part. It was fueled mainly by a 359% increase in non-interest income. And most of that came from their loan platform business, the LPB.
The LPB, that's where they originate loans for others.
Exactly. They generated $127.4 million in revenue just from that originating loans for third parties. It's high margin because it's fee-based, and it's capital light because SoFi isn't holding all the risk on its own balance sheet. It completely validates their strategic shift towards more fee income. Makes the whole business less risky and more resilient.
That's a brilliant move. Grow rapidly, but manage the risk by partnering. Okay, and the third segment, technology platform.
Right. The tech platform. This includes Galileo and Technisys. They provide the back-end infrastructure for other banks and fintechs. This segment provides a steady foundation. Growth was solid. Revenue up 15% to $109.8 million, and profit up 7% to $33.2 million.
More moderate growth there.
More moderate, yes, but it's stable, it's recurring, it's fee-based revenue, adds important diversification to the overall mix. And they had a nice strategic win there, too. They signed Banco Nación, which is Argentina's largest bank, as a client for their cyberbank digital platform. Shows their tech has international appeal.
Okay, so lending core, financial services booming, tech platform steady and diversifying. How do these all fit together in their strategy?
It all comes back to what SoFi calls their financial services productivity loop, or FSPL. You might hear it called their flywheel.
The flywheel, right?
The idea is simple but powerful. They acquire a member through one product, maybe a personal loan or SoFi Money. Then, because they have this integrated platform, they can efficiently cross-sell other products, checking, savings, invest, credit cards, whatever.
And are they actually doing that effectively?
The numbers suggest yes. They said 35% of the new products opened this quarter were by people who are already members.
So the cross-selling is working.
Seems like it, and maybe even more telling, the revenue per product in that financial services segment jumped over 50% year over year. So members are using more products, and those products are becoming more valuable. This whole integrated system creates compounding growth. As they add members and products, the cost to acquire that next dollar of revenue tends to go down, which helps margins expand, like we saw dramatically in financial services.
That makes sense. The
Yeah.
ecosystem feeds itself. Okay, let's turn to slide 4. Financial strength and shareholder rewards. We know they're growing fast and profitably, but how solid is the underlying foundation, the balance sheet?
It looks incredibly solid. You could really call it a fortress balance sheet at this point. Let's look at a few things. First, capital adequacy. As a bank, they have strict capital rules. Their CET1 capital ratio, that's Common Equity Tier 1, was 14.3% at quarter end.
And the minimum required is?
Only 7.0%. So they're holding more than double the regulatory minimum. That's a huge buffer. It gives them tons of capacity for more loan growth without stressing their capital.
Okay, very well capitalized. What else?
Deposits. We touched on this, but deposits grew to $29.5 billion. And crucially, almost 90% of their SoFi Money deposits are from members who have direct deposit set up.
Why is direct deposit important?
It indicates sticky, high-quality relationships. These aren't just hot money deposits chasing rates. It means it's a stable, reliable, and very low-cost source of funding, a cornerstone of their strength.
Got it. Stable funding.
And finally, shareholder equity is growing. Tangible book value per share, which is a measure of the net asset value per share, grew nicely. It went from $3.94 a year ago to $4.72 this quarter.
So the actual intrinsic value per share is increasing.
Exactly. Direct value creation for the owners of the company.
Okay, strong balance sheet, growing intrinsic value. Now, about capital allocation, we know the share count went up. Why aren't they, say, buying back shares or paying a dividend yet?
That's a fair question, especially when you see profits growing so fast. But it really comes down to their stage of growth. They're still very much in high growth mode. So the priority right now is reinvesting every available dollar back into the business to capture these massive growth opportunities they see.
Rather than returning cash to shareholders immediately.
Right. We acknowledge the share count rose, mainly from share-based compensation, which is pretty standard for tech companies trying to attract top talent. But here's the argument for why reinvesting is the smart move for SoFi right now. The returns they're generating on that reinvested capital are phenomenal.
Like the growth in financial services.
Exactly. That 241% profit growth in financial services, the overall 700% APS growth, that shows their internal investments are yielding exceptional returns. As long as they can keep finding ways to deploy capital internally and generate those kinds of high returns, reinvesting is actually the best way to build long-term shareholder value. It's better than buybacks or dividends at this specific stage.
Okay, that makes strategic sense. If you can earn way more by putting money back into the machine, you keep doing that. All right, final section. Let's go to slide 5, the road ahead management's outlook and key takeaways. After such a strong Q2, what's management telling us about the rest of 2025? And what are the big lessons here? Well, first off, they significantly raised their full-year guidance for 2025, pretty much across the board.
Confidence is high.
Adjusted net revenue guidance raised to about $3.375 billion. That implies around 30% growth for the whole year.
Still very strong growth expected.
Adjusted EBITDA guidance boosted to approximately $960 million. That represents a healthy 28% margin.
Nice margin guidance there.
And on the GAAP side, they raised net income guidance to about $370 million, leading to an expected GAAP EPS of roughly 31 cents per share for the full year.
So, substantial upgrades reflecting the momentum they're seeing. And the CEO, Anthony Nato, really summed it up well in his comments. He said, and I'm quoting here, "We accelerated adjusted net revenue growth to 44% year over year, the highest level in over 2 years, driven by record high new members as well as new products and an increase in fee-based revenue."
Captures all the key drivers.
Yeah, and he continued, "This consistent, disciplined investment across our platform, combined with unmatched products and services, uniquely positions us to capture the massive and expanding opportunities ahead." Really underscores their confidence and strategy.
Okay, so based on all this, the results, the guidance, the CEO's comments, let's crystallize the key takeaways for everyone listening. What really stands out from Q2? First, I'd say it was a decisive beat and raise that just shattered any cautious expectations out there. Significantly better numbers than predicted, and then a big guidance hike. Signals real momentum.
Absolutely. Can't argue with that. Second, the strategic diversification. It's not just a plan anymore. It's clearly the primary growth engine now. That hyper growth in financial services, especially fueled by that capital-light LPB business, it validates the whole strategy. They're building a more resilient, diversified, high-margin model, and it's working.
Good point. Third, profitability isn't just growing, it's scaling at an accelerating rate. We saw that operating leverage. They've hit that inflection point where revenue growth leads to much, much faster profit growth.
Powerful dynamic. And fourth, that bank is a fintech model. It's proven itself as a real competitive moat. Using the bank charter to build that fortress balance sheet with low-cost deposits, it's fueling profitable growth and gives them a lasting edge over competitors who don't have that cheap funding base.
Okay, so beat and raise, diversification driving growth, accelerating profitability, and the bank charter as a moat. That sums it up well.
Yeah, and maybe just to wrap the narrative of the quarter, Q2 2025 wasn't just one good quarter in isolation. It really felt like the culmination of their whole multi-year strategy. Remember, they started mostly in student loan refinancing. Now, they've clearly transformed into this diversified, integrated digital financial services platform. Q2 was the proof point.
The strategy paying off.
Exactly. You see that powerful flywheel effect really spinning now, record member growth, more products per member, scaling profits, all feeding each other. And that decisive beat and raise, it felt like the market finally acknowledging, okay, SoFi has done it. They've built a business with multiple ways to grow, a strong moat with the bank charter, and a clear path to sustained high-quality earnings.
A really strong quarter signaling a potential new phase for the company. It leaves you thinking, doesn't it? What does this level of execution mean for the future of traditional banking, and how might SoFi keep disrupting things from here?
Okay, before we wrap up, just the important reminders. This deep dive, it was based only on the sources and data we discussed today, and is purely for informational purposes. That's absolutely right. This report is strictly for informational purposes. It is not financial advice, not investment advice, not legal or tax advice. You need to do your own research. And always consult with a qualified financial professional before making any investment decisions. We've tried to be accurate, but there's no guarantee on the information provided.
And one more crucial point. This report was generated using an artificial intelligence model. It pulled data directly from SoFi's official earnings release and public market data via web searches. While the AI aims for accuracy and follows verification steps, errors or omissions can still happen. So please, independently verify all the information yourself, especially any financial data or calculations, before making decisions based on it. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.